Welcome to Talk Tickers. Today, we are not just looking at a stock or a sector. We are looking at the plumbing, the pipes, the actual machinery that decides what price you get when you hit that buy button.
It really is. It's the invisible infrastructure that, determines the cost of everything in the market.
Exactly. We are talking about the systematic internalizer, or the SI. Now, if you're a sophisticated investor, you've probably heard the term, you've seen the acronym, but I think most people, even pros, they sort of treat it like a black box. They think, okay, it's just another way to trade, but it's not. It is fundamentally different from an exchange.
Oh, completely. It's the difference between trading against a mechanism and trading against a balance sheet.
A balance sheet, that's the key.
And that distinction changes everything from your execution quality to information leakage to the true cost of liquidity.
And here's the hook, right? The market isn't just lit anymore, like, the New York Stock Exchange or the London Stock Exchange where everyone sees everything.
Right.
And it's not just dark pools where the lights are completely out. We are living in this world of quasi-dark liquidity. And the SI is basically the king of that world.
And it's a world that is undergoing a massive shift right now. I mean, specifically looking at the 2025 and 2026 regulatory overhaul.
A huge shift.
The rules of engagement are changing. They're moving from a mandatory, you must do this kind of regime to a more strategic, I choose to do this regime.
So it's becoming a choice.
It is. And if you're moving real money, you absolutely need to understand who is on the other side of your trade. Is it just a matching engine? Or is it a bank taking a risk position against you?
So let's unpack this. We are going to strip this whole thing down to the studs. What is an SI? How does it differ from an exchange? Why did the regulators even create this beast? And how did it kind of accidentally eat the market? And crucially, what does this new voluntary regime mean for your execution?
So let's start with the basics, the definition. What exactly is a systematic internalizer?
At its core, an SI is an investment firm. So it could be a massive investment bank, a high-frequency trading shop, or a broker. But the key is, and you said it earlier, they deal on their own account.
That is the phrase to underline, on own account. When you send an order to an exchange, the exchange isn't buying your stock.
Right.
The exchange is just a dating service introducing you to a seller. But when you trade with an SI, the SI is the seller or the buyer. They are your counterparty.
Right. They're executing client orders outside of a regulated market, an RM or a multilateral trading facility, an MTF. They are taking the trade onto their own books.
And to qualify as an SI, this activity has to be three things: frequent, systematic, and substantial.
Frequent, systematic, and substantial.
Those are the regulatory catchphrases. It wasn't just, doing a favor for a client once a month. It had to be a core business model.
So this brings us to the core distinction. If I had to boil this entire deep dive down to just one concept, it would be this: multilateral versus bilateral.
This is the legal and the functional divide. An exchange, whether it's the LSE, Euronext, or an MTF like SIBO, is multilateral.
Okay.
It brings together multiple third-party buying and selling interests. It's all to all. I put an order in, you put an order in, a pension fund puts an order in, and the engine just matches us based on price and time priority.
And the SI is strictly bilateral, one-to-one.
Correct. The SI is not allowed to match client A with client B inside their system without taking the risk themselves.
So they can't just act as a middleman.
They cannot act as a riskless pass-through. If client A wants to sell, the SI must buy it. If the SI then turns around and sells to client B 5 seconds later, well, that's their business. But for that moment, the SI owns the risk. The SI is the counterparty to every single trade.
Which changes the risk profile completely, doesn't it? An exchange is risk neutral. It doesn't care if the market crashes 5 minutes after the trade.
Not at all. It collected its fee. It's happy.
Yeah.
An exchange is a venue. An SI is a liquidity provider. It's a risk-taking entity. They are essentially single dealer platforms that have been formalized under this specific regulatory regime.
So they're betting.
They are absolutely betting. They're betting they can buy from you, hold the risk, and then hedge it or sell it later for a profit. They have skin in the game. An exchange has zero skin in the game.
And that distinction, I imagine, explains why they behave so differently when the market gets scary.
Oh, absolutely. We'll definitely get to that.
But first, we need to understand how we even got here. Because the SI wasn't always the giant execution venue it is today. It was born out of a regulatory struggle, wasn't it?
It was. Yeah. You have to look back at the origins from MiFID I all the way to MiFID II. The European regulators have had this long-standing obsession with transparency.
They want everything lit.
Exactly. They want everything lit. They want every trade to be visible to the public so that price formation is, efficient and fair for everyone.
But banks have always internalized flow. I mean, if I'm a big bank and I have one client buying Vodafone and another client selling Vodafone, it makes no sense to send both to the exchange and pay fees. I just match them in-house.
Of course not. And regulators viewed that with extreme suspicion. They called it internalization. And they worried it was a black box where clients might get ripped off or where the broader market wouldn't see the liquidity.
Right.
So they created the systematic internalizer category to regulate these internalizers.
Right.
The logic was basically, if you are going to act like a mini exchange inside your own bank, we're going to treat you like a mini exchange. You will have quoting obligations.
But the real explosion in SI volume didn't happen until MiFID II, specifically with something called the double volume caps, or DVCs. This is just a classic case of unintended consequences.
It really is. One of the best examples in modern markets. MiFID VI came in with a sledgehammer to try and, to kill dark pools.
They hated dark pools.
They hated them. So they introduced the DVCs. And basically they said a stock can only trade 4% of its total volume in a single dark pool.
Okay, 4%.
And only 8% of its total volume in all dark pools across the entire EU.
The 4 and 8% rules, and they thought this would force everyone back to the lit exchanges, right?
That was the hope. That was the entire plan. They capped the dark pools. They banned the broker crossing networks. They thought, okay, now all that volume has to go to the public limit order book.
But water finds a crack. The volume did not go back to the lit markets.
No, it did not. It flowed to what we now call quasi-dark venues. Mm-hmm. And the single biggest beneficiary was the systematic internalizer.
Because SIs are exempt from the double volume caps.
Exactly. You've hit the nail on the head. The regulations capped multilateral dark trading. But remember what we said, an SI is bilateral. It's a dealer trade. So the caps didn't apply. And suddenly, CEIS offered a way to trade away from the pre-trade transparency of the lit book, meaning you don't signal your hand to the whole world without the constraints of the dark pool caps.
And the numbers back this up, don't they? I mean, we saw CEIS explode from having maybe, 2% market share to over 20% in some data sets post-MiFID II?
It was an incredible shift. The regulators squeezed the dark pool balloon, and it just bulged out into the SI sector.
Smooth the problem.
Move the volume. And some of it went into periodic auctions, which is another quasi-dark mechanism. But SIs were absolutely the primary destination for that bilateral flow. It became the new home for execution that wanted to avoid the harsh light of the public exchange, but couldn't fit into the capped dark pools.
Now, you mentioned things are changing. The definition of an SI has been evolving. It used to be this really complex numbers game. You had to calculate turnover ratios, count trades, and if you crossed a certain threshold, boom, you were legally forced to be an SI. It was mandatory.
It was a very rigid quantitative test, a numbers game, as you said. If your trading activity hit certain metrics, frequent, systematic, substantial, you had no choice in the matter. You were an SI with all the reporting burdens that came with it.
But that is changing, right now. We are in the middle of a massive overhaul for 2025 and 2026, both in the UK with the FCA and in Europe with the SMA.
We're moving from that mandatory volume-based regime to a qualitative, voluntary opt-in regime.
Voluntary.
The regulators, I think, realized that the strict quantitative thresholds were a massive headache to calculate, and they didn't actually serve the market structure all that well. So they're scrapping the mandatory math test.
So now a firm just chooses to be an SI. They can just raise their hand?
Essentially, yes. Firms will voluntarily opt in for strategic or commercial reasons. Yeah. And this is a huge shift in thinking. It also means the famous SI registry, that massive database of who is an SI for what stock is being decommissioned.
Wow. Okay.
The industry realized that, that granular data registry was no longer necessary if the whole regime is voluntary.
That feels like a mature market move. It's almost like the regulators saying, look, you all know who the dealers are. We don't need a government spreadsheet to tell us.
Precisely.
Yeah.
It puts the onus on the firm to declare their status. And we should get into this because there are very real commercial reasons why a bank would want to volunteer for this regulation. It seems counterintuitive, but it's true.
Okay, so let's get into those mechanics. How does this actually work day to day? We said the SI is a dealer, but what does that actually look like from their perspective?
From the dealer's perspective, it is all about inventory management. The SI must stand ready to buy or sell. They aren't matching client A with client B directly. They are intermediating. If I sell to an SI, The SI now owns that stock.
Okay.
They now have inventory risk. They might hold it for a minute, an hour, or a day. They might hedge it with futures. They might turn around and sell it on a lit exchange. But for that moment, it is on their balance sheet.
And because they are regulated, like a mini exchange, they have quoting obligations. This is where it gets a bit technical, but it's really important. They can't just make up prices in the dark.
No, they can't. For liquid instruments, so think mostly large cap equities, CES must publish firm quotes. They have to show a price to the market. But there is a catch.
Always a catch.
They only have to do this up to the standard market size, or SMS.
The SMS. This is a critical threshold. And it's usually something like, what, 10,000 euros for a typical stock?
It's a good ballpark, yes.
Yeah.
For trades below that size, so retail size, essentially the SI must be transparent. They must publish quotes that are firm. If you click trade, you get that price. It's locked in.
But what about for orders larger than the standard market size?
That's where the rules change. This is the quote on request nuance.
Okay.
If you want to trade a block, say €500,000 of something, the SI does not have to display that quote to the public. They can provide a quote privately, just to you, the client.
Which effectively makes it a quasi-dark trade.
Yes, exactly. It retains the privacy of a dark pool, but it happens bilaterally. The rest of the market doesn't see that quote before the trade happens. And that is the huge appeal for institutional investors. You get a price without tipping your hand to all the high-frequency traders on the lit exchange.
What about pricing itself? Can they offer any price they want? I remember in the early days, CES used to offer what they called price improvement. They would beat the exchange by a fraction of a penny subpennying just to steal the flow.
Oh yeah, that was the Wild West. Originally, CES had a lot of flexibility to offer that kind of price improvement to attract flow. They would look at the exchange spread, say it's 10, even at 10.02, and they would offer to buy at 10.001.
Just enough.
Just enough to win the trade, but barely better than the exchange. And regulators hated this. They felt it completely undermined the lit markets.
So they tightened the screws with the tick size regimes.
They did. Now, SIs are generally forced to adhere to standard pick sizes for smaller trades. They cannot just step in front of the queue by a microfraction anymore. They have to compete on legitimate price levels or by offering more size. This was all done to prevent what they saw as unfair undercutting of the exchanges.
Let's go back to this opt-in strategy. It still seems a bit strange. Why would a firm voluntarily sign up for this? Being an SI sounds like a lot of paperwork. You've got quoting obligations, data reporting. Why raise your hand and say, hey, regulate me?
It comes down to two things: commercial capability and, crucially, client service. There is a massive, massive incentive for the buy-side, the asset managers, the pension funds, to trade with SIs.
And that incentive is reporting.
It's compliance, pure and simple. If a buy-side firm trades with a dealer who is not registered as an SI, the regulatory burden of real-time trade reporting, so sending all the data to an APA, an approved publication arrangement, that burden often falls on the buy-side firm itself.
And no asset manager wants to hire a team of people just to report trades to the regulator. That's not their business. They want to trade and go home.
Exactly. So the dealers use this as a selling point. They say, hey, trade with me. I will opt in as an SI. That means I am legally the senior party in the trade. I will handle all the reporting. I will handle the compliance headache. You just focus on trading.
Wow.
It becomes a service offering. Trade with me, and I handle all the paperwork.
That is fascinating. So the regulation itself became a product feature. We are an SI, so you don't have to worry about MiFID.
Precisely. And the granularity under the new rules is amazing. Dealers can opt in at the entity level, the asset class level, or even down to the specific issuer or a single bond. A bank could literally say, we're an SI for Vodafone and BP, but we are not an SI for this small cap miner over here.
This brings up the reporting regimes, and I know this is alphabet soup, but stick with us because it determines who tells the market what just happened. We're talking about the designated reporter, DR, versus the designated publishing entity, DPE.
It's vital plumbing. The FCA in the UK uses the designated reporter, or DR, regime. It's an entity-level status. If you register as a DR, you report. It's pretty simple. ESMA in Europe uses the designated publishing entity, or DPE. That is more asset class specific.
And the complexity really comes when two banks trade with each other, right?
Yeah. If a buy-side firm trades with a bank, it's easy. The bank reports. But if Bank A trades with Bank B, who reports? You need a hierarchy of responsibility.
A pecking order.
A pecking order, yeah.
Correct.
The system is designed so that the SI, the one holding themselves out as the liquidity provider, is usually the one to report. But with these new voluntary regimes, you have to actually check the register. Are you a DPE for this bond? No. Okay, I am, so I report.
It sounds purely operational, but if you get it wrong, you get fined.
Or you double report, which confuses the market data. Or you under-report, which is, breaking the law. It's a big deal.
Okay, let's pivot to the deep analysis. The market microstructure. This is where we look at who is trading where and why. We know S act as dealers, but what I find so interesting is how they choose who to trade with. Unlike an exchange, they can just say no.
And that ability to say no, or to quote differently to different clients, that allows for what economists call cream skimming.
Cream skimming, it sounds delightful, but I'm guessing the exchanges hate it.
Oh, they despise it. SICE and dealers in general, they prefer what's known as uninformed flow.
Okay, you have to define uninformed. That sounds like an insult to the investor.
That's not an insult at all. It's a technical classification of risk. Uninformed flow is usually things like retail flow, corporate buybacks, or passive indexing.
Okay.
It is flow that is trading because it needs to trade for some external reason, not because it knows something the market doesn't know yet.
So if I'm buying stock because my index fund got a deposit this month, I'm uninformed.
Yeah.
I don't have a secret tip that earnings are going to be a disaster in 10 minutes.
Exactly. And for that reason, dealers love you. Because the price isn't about to move violently against them. The risk of what they call toxic flow is very low.
Right.
So SICE can offer tighter spreads to these clients. They can give you a better price than the exchange because they know you aren't about to run them over.
And conversely, informed flow is dangerous to them.
Highly dangerous.
Yeah.
This is your hedge funds, your arbitrage desks, your news traders. If a high-frequency trader wants to buy $10 million of a stock right now, it's probably because they think the price is about to go up. If an SI sells to them, the SI is now short, and then the price goes up. The SI loses money. That is the classic definition of adverse selection.
So the SIs try to filter that out. They screen their clients.
They absolutely do. They monitor client flow constantly. If a client consistently runs them over, meaning the price moves against the SI right after they trade with them, the SI will just widen the spread for that client. Or, in many cases, just stop quoting to them altogether. They reject the flow.
And where does that rejected toxic flow go?
It goes to the lit exchange. Because the exchange cannot say no. It is an all-to-all anonymous limit order book.
So the lit exchanges become the dumping ground for all the toxic flow.
That is the argument, yes. The lit exchanges can become toxic pools of informed volatility, while the rest capture the safe, profitable, uninformed volume. It creates this bifurcated market. Safe flow goes bilateral. Dangerous flow goes multilateral.
And this must have huge implications for price impact.
It does. I mean, it's one of the main selling points. Trades on SIs generally have lower price impact than on lit exchanges.
And why is that?
It's because there is no pre-trade signaling. If I want to sell a huge block on the LSE, everyone sees the book in balance. They see my order. The market moves away from me before I can even get my trade done.
Sharks smell blood in the water.
Precisely. On an SI, it's just me and the dealer having a private conversation. The market doesn't see it until after the trade is done and reported.
But there's a flip side to that, isn't there? Price discovery.
There is. This is the trade-off. Academic findings generally suggest SIs contribute less to price discovery than exchanges. And the reason is, SIs are usually just referencing the exchange price.
They're piggybacking.
They are. They're piggybacking on the price formation that's happening on the LSE or Euronext. They aren't setting the new marginal price. They are matching at or slightly better than the existing price.
So in a way, they are price takers, not price makers, in a systemic sense.
In a systemic sense, that's a very good way to put it. They are providing liquidity, absolutely, but they're relying on the lit market to tell them what the stock is actually worth.
No, we can't have this conversation without talking about high-frequency trading. A lot of people think HFTs just sit on exchanges. But they operate as SIs too, don't they?
Oh, HFT SIs are a massive part of the landscape. I mean, you look at firms like Citadel Securities, XTX Markets, Virtu. They operate as SIs, and their behavior is fascinating to watch.
How so?
It's all about inventory unwinding. When an HFT SI buys stock from a client, say a retail broker, sends them all their flow, the HFT now has a long position. They don't want to hold that risk. They want to be flat almost instantly. So what do? They very often turn around and offset that risk on the lit exchange.
So they buy privately from the retail client and then they sell publicly on the exchange.
Exactly. And some research suggests that when HFTs act as SIs, they actually reduce their own liquidity provision on the public exchange at the same time. They'll pull back their quotes on the LSE to help them manage the risk they just took on internally.
So the existence of the SI can actually degrade the quality of the lit market in real time.
That is the fear. It's a concept called liquidity withdrawal. If the HFT is busy servicing its internal SI flow, they are less present in the public book. Also, they tend to undercut. SIs are most active when exchange spreads are wide.
Because there's more profit to be made?
Of course. When the spread is wide, it's very easy to offer a slightly better price and still make a huge profit. When exchange spreads are tight like one tick wide, it's very hard for an SI to beat the market and make money.
So they can be fair weather friends in a way?
In a way, yes. They are there when there is a clear margin to be made.
Okay, let's talk about substitutes. We mentioned the double volume caps earlier. The SIs are basically just substitutes for dark pools.
They are. It's economics 101, substitute goods. If you ban or cap dark pools, people don't suddenly decide they want to trade on lit markets. They still want the benefits of darkness, low impact, privacy, so they just go to the next closest substitute.
Which was the SI.
The SI. And to a lesser extent, the periodic auction.
Periodic auctions are interesting. They are technically lit, I think, but they happen in these short bursts, right?
Yeah, they are frequent batch auctions. They run for milliseconds at a time. They provide a way to trade that protects against speed latency, because raw speed doesn't matter as much in an auction. And they offer a form of quasi-darkness, because you aren't displaying a continuous quote. The ban on dark pools drove a huge amount of volume to SIs and periodic auctions, not to the continuous lit book as the regulators had intended.
Let's bring this all back to the investor. The person listening to this who actually manages a portfolio. Why should they really care about the microstructure of SIs?
It matters for your portfolio implications, specifically for your execution quality analysis or TCA transaction cost analysis. You absolutely need to analyze where your broker is routing your trades.
So if I get my TCA report and I see my broker is routing, say, 50% of my flow to their own in-house SI, is that a good thing or a bad thing?
Well, it depends. It could be good. High routing to SIs might mean you're getting better pricing. They might be giving you consistent price improvement, but it could also indicate the broker is internalizing your flow primarily to capture the spread for themselves. You have to ask the question, are they routing to the SI because it's best for you or because it's most profitable for them?
That's the classic conflict of interest right there.
It is. And then there's information leakage. If you are trading a large block, an SI offers great protection against leakage compared to a lit market. You don't signal your intentions to the whole world.
Okay.
However, the counterparty, the bank, knows your position. They know exactly who you are and what you're doing.
And if that bank also has a proprietary trading desk?
Well, they have information barriers and firewalls, of course, but the counterparty knows. In a lit market, the market sees the order but doesn't know it's you. In an SI, the market doesn't see the order, but the bank knows it's you. It's a very important trade-off.
And then there is market fragility. We touched on this. CIS, take risk. Exchanges don't.
This is the critical stress test scenario. In times of extreme volatility, think about the pandemic in March 2020. SIs, who are taking risk, may widen their quotes significantly. Or, if the regime is voluntary, they might just stop quoting altogether.
They just pull the plug.
They can just pull the plug. We're not playing today, it's too risky.
But the exchange has to stay open.
The exchange takes no risk. It's just a machine. It remains open. So this reliance on SIs works extremely well in calm markets. It's cheap, it's fast, it's efficient. But that liquidity can be, well, phantom in a way. It can evaporate in stress events, forcing all that volume back to the lit books where liquidity may be much thinner than it appears because everyone was relying on the SIs.
So the opt-in signal we talked about for 2025 is actually a kind of quality signal for banks, a way to see who's serious.
I think so, absolutely. Watch which firms opt in under the new 2025 voluntary regime. It signals a real commitment to market making and the technology infrastructure required. It's them saying, we are serious about this business, we are opting in. Those who don't opt in may be quietly stepping back from liquidity provision. It helps you sort the real players from the tourists.
That brings us to the one question, the single question our listeners should be asking their broker or their trading desk about this entire topic.
The question is this: is the liquidity I am accessing risk-taking capital, or is it risk-neutral matching?
Is the liquidity I am accessing risk-taking capital or risk-neutral matching? Explain why that specific question matters so much.
Because risk-taking capital, the SI, will often offer you a better price when you're uninformed and the sun is shining. but it will vanish or widen dramatically when the market turns against you. Whereas risk-neutral matching the exchange, it might cost you a little more on average, maybe, but it provides the true market clearing price in all weathers. You need to know which one you are relying on for your execution.
Boom. That is the takeaway. Know your counterparty. Know what you're trading against.
Absolutely.
So, to recap the 3 main points for today's deep dive. 1. An SI is a single dealer platform. It's bilateral, it takes risk, and it is the quasi-dark alternative to the lit exchange.
2. The regulatory crackdown on dark pools, those double volume caps, it didn't really fix transparency. It unintentionally strengthened the SI regime. It just shifted market structure from multilateral dark pools to bilateral internalizers. The balloon just bulged somewhere else.
And 3. The upcoming regime shift in 2025 and 2026 is a big one. It's moving SIs from a mandatory math-based status to a voluntary strategic status. Firms now have to opt in to be SIs, and they'll largely do it to provide a reporting and compliance service to their clients.
It's becoming a service industry, not just a pure trading function.
And I'll leave you with this final provocative thought. If SIs are becoming voluntary, and they are essentially private liquidity pools run by dealers, are we slowly moving toward a world where the lit market is just the reference price for the real trading that happens in the dark? Are the public exchanges becoming just the scoreboard while the actual game is played somewhere else?
That is the existential risk for public markets. If price formation becomes a byproduct of private trading rather than the main event, the whole system could get a lot more fragile.
Something to mull over.
Yeah.
As always, none of this is investment advice. Do your own diligence, and definitely check your execution report.
And ask the hard questions.
Thanks for listening to Talk Tickers. We'll see you in the next deep dive.